All right, everybody, how's it going? This is Michael Lamar here, and today I'm super excited to have my friend Mike on as a guest speaker. He's going to be talking about covered calls and making more income. Mike and I first met actually a few years ago where we had lunch down in Ventura, just a little bit south of where I live. We were talking shop on covered calls. Now, he's been trading covered calls, I think, for over 30 years. We were just kind of talking about what he's been doing with his Apple shares. And he's really an expert when it comes to the best and safest ways to trade covered calls. And nowadays, income is so important for people. And we've had a lot of people in our community actually ask me to bring on an income trading expert. And Mike was the obvious choice. So I'm really looking forward to his presentation today. And I hope you are too. With that, I would like to introduce you to my good friend, Mike.
Hey, Micah, and hey, everyone. Thanks for the opportunity and nice to be here. I'm going to take about probably 30, 40 minutes to talk about covered calls in general, and then show you some software that might help with covered call investing. And throughout, I'm happy to be interrupted by Micah or in the chat session. If people have questions, feel free to jump in. So I'm also going to talk a little bit about who am I, give you a brief bio on me, tell you about the amount of time premium that exists in the world today, show you a few long-term studies that other people have done on covered call risk versus reward, then show you some specific tactics you can use to either lose less or make more, and then jump into a demo. And there's also going to be a special offer at the end for Wall Street users. So I've been trading covered calls since the 80s. My father was a stockbroker and taught me when I was a teenager. I've had sort of three major careers. One was as a programmer, one was in finance, investment banking, and venture capital. And since 2009, I've been running a Born to Sell, which is a website for covered call investors. And the site does pretty well. It has won first place in 3 of the last 5 years for trading software in the options category as a survey done by Trader Planet, which was a popular vote. So today I did a quick search, and there's 415,000 different unique call options. So all combinations of underlying strike price and expiration date. There's 167 million contracts across those 415,000 covered calls, and the total time premium, not including the intrinsic value, is about 15 billion as of this morning. And that is all going to decay to zero as it approaches expiration. So what happens to all of those 167 million contracts? Well, 60% of them are closed prior to their expiration date. Of those that are held until expiration, about 10% are exercised, they finish in the money, and 30% expire out of the money. So if you eliminate all of those that are closed prior to expiration, it is a truthful statement to say that 75% of those that are held until expiration will expire worthless. So that's good for sellers. You'll be right 3 out of 4 times. And that's why our site is called Born to Sell, selling options to other people. Charles Schwab has said that 84% of the investors who trade options at Schwab use covered calls. So that's about 4 out of 5 investors who trade options are doing covered calls. And Trade King has said that covered calls as a strategy are the #1 most popular strategy amongst all the retail accounts. So why is it so popular? Mostly because it's fairly easy to hit a winner. It's fairly consistent in its ability to generate profits as a strategy. But you can also get hosed, and there are definitely risks, and those risks can be magnified by greed, margin, or not doing your homework on what you're buying. Covered calls work really well in many different markets. Sideways, slightly down, or slightly up, they do great. If it's a strong directional market, up or down, then they're not the best. This is a little chart I put together to show sort of what is the best strategy, depending on the market type, and what is an okay or a good strategy. And you'll see that it's an okay or a good strategy to use covered calls in all market types. It just depends on the strike price relative to the stock price. Are you in or out of the money? And if you're in a sideways market, at the money covered calls are about the best strategy because you'll be generating income even though the underlying isn't really going anywhere. In strong directional, it's not the best, but it's an okay strategy. That's why they're popular. This is from the Wall Street Journal, which basically compares covered calls that are systematically used as a buy right index versus its benchmark, which is the S&P 500. And over 20 years, it shows that the buy right index performed slightly better, 8.4 versus 8.3, basically a wash, but that the standard deviation was much lower for the buy right index. So covered call enthusiasts like to say it's equal or better returns, but at much lower volatility. There have been many academic studies that kind of prove that point, and I'll give you the highlights of these two studies in the next slide. The University of Massachusetts did a 15-year study talking about different buy right strategies on the RUT symbol, which is the Russell 2000. And then Asset Consulting Group did a 23-year study of different kinds of index buy rights and comparing them to various benchmarks. And the key findings, those studies are available on my site along with 3 or 4 others. They all tend to say the same thing. This is an example from the first one, which shows that covered calls outperform buy and hold over the time period that this study was done, from 96 until 2012. And it's the dotted line is the covered call line, and the solid gray line is sort of the buy and hold line. The Asset Consulting Group study examined the strategy of taking the BXM and comparing it to the BXY and their underlying benchmark, the S&P 500. The BXM is a systematic strategy of writing at 1 month calls at the money on the S&P 500. So their underlying index is the S&P 500. And over 23 years, it shows that I'm sorry, I just did something I shouldn't have done here. All right, did I just put the PowerPoint slideshow back? Yes. The BXM and the BXY have a higher annualized return than the S&P 500 over this 23-year period. And through 2 measures of volatility, the standard deviation and the beta, they were lower volatility. So better returns at lower volatility. And if you think it would just sort of cherry pick the time period, they also looked at it from a 1-year, 5-year, 10-year, and 20-year perspective. And in every time frame that ends at 2011, they performed with a higher return over each of those time frames. So what is a covered call? I'm not going to spend a whole lot of time on this because I assume that this audience typically knows, but basically it's a 2-part trade where you're long the stock and you're short a call option against that stock. And since a call option controls 100 shares, you want to buy 100 shares of a stock or an ETF, and then for every 100 shares you own, you will sell 1 call option against it. And if that's not clear, we have a free tutorial with examples at our website if you just click on tutorial in the menu bar. Let's take a quick look at the P&L graph. This is what buy and hold looks like. You're all familiar with this. The orange line is your profit. The purchase price is this little blue line here in the middle. And if the stock goes up, you make money. If it goes down, you lose money. Let's layer on a covered call. And the covered call P&L line is the black line, which is sort of the same as the orange line, but shifted to the left by the amount of the time premium that you collected. And then it has this sort of kink at the top, which is the strike price. You can't do better than the strike price when you sell a covered call. Well, the strike price plus the option premium that you received. So for many values on the price of the stock price axis, which is this horizontal axis, the black line is higher than the orange line. And that means covered call would beat the buy and hold. However, when the stock price goes above the sum of the strike price plus the option premium, then buy and hold starts to do better. So you're not going to, if the stock takes off to the upside, you won't do as well, but in every other case, you do better. The pros of covered calls is you receive the cash on the day that you sell the call options. It will create additional yield on the stocks that you may already own. So if you're not doing it today and you own stocks, you're probably just leaving money on the table. You could be writing out of the money covered calls on your stocks. It will lower your break-even point, making it more conservative than a buy and hold strategy, and it will lower your account volatility, especially if you do it in a disciplined, diversified way. The negatives are that it puts a cap on your upside, and you can still lose money. There's no guarantees here, and if the stock drops a lot, specifically by more than the option premium you received, you will still lose money. You will lose less than a buy and hold investor, but you'll still lose, and if the stock drops by a whole bunch, losing 3% less is not a consequence. So there's two ways to end up with more money. We're going to talk a bunch about how to lose less and ways to avoid risk, and then talk specifically about how to make more money with what you have. So the first way to lose less is to stay diversified. And let's take an example where you have a $50,000 portfolio and maybe you're a techie and you like a whole bunch of tech stocks. So you just want to go buy $10,000 of 5 different tech stocks. That's one strategy. Alternatively, you could pick 2 of your tech stocks, put $5K into each of them, and then go find $40,000 worth of non-correlated investments in other sectors. That is generally a better strategy as a diversification strategy. And I wouldn't put, in general, more than 10% of your portfolio into a single stock or more than 20% into a single sector. And those are just rules of thumb. That gives you some flexibility to still sort of overweight yourself on a particular stock or sector, but not to go totally crazy. Our software has the ability to show you your diversification if you're over or underweighted by 9 basic sectors. It takes the S&P 500 and it breaks it down market cap by each of these sectors. Those are the orange or the gold lines. And then it looks at your specific portfolio and weights it according to the sectors, and those are the gray lines. So this particular demo portfolio is very heavy in tech and financial. It might be time to sell some of those stocks and buy something in a different sector to increase diversification. Another important point, kind of related, is the position size. And again, if you have a $50,000 portfolio and there's one particular stock that you just love, do you just back up the truck and go 50K on that one thing, hoping for the big score? Or, should you put 10% of your portfolio into that and then go find 9 other non-correlated things that you could invest 5,000 into, which is generally a safer strategy. Again, I'm playing for the long haul here, not for the get rich quick. And I should say as an overview that covered calls is not a get rich quick strategy, it is a get rich slowly strategy, and hopefully minimizing your losses in bad years, as well as making decent amount in good years. One thing that covered calls are not very good at capitalizing on is earnings dates, and it's tempting because the premiums are really juicy around an earnings date. But if you want to make a directional bet that something's going to have good or bad earnings, you probably should either buy the stock long or short it, or buy a call option or buy a put option. But none of those things are covered calls. Covered calls generally are pretty poor instruments to take advantage of your opinion on which way earnings are going to go. In our screener, we have the ability to set the expiration date, which is a slider control of future expiration dates. Right now, it's set for May 19th, this coming monthly expiration. And if there is an earnings prior to that expiration date that's been selected, it shows it to you in red. So in this sample, all of these have an earnings release prior to the option expiration date that was chosen. Now we have and as a consequence, they have really high annualized rates of return. Everything here is over 140% because of the earnings volatility. We have a really easy feature. It's called Earnings Before Expiration checkbox. And if you uncheck it, it will remove all covered calls that have an earnings release prior to the expiration date that you've chosen, which is a really simple way to de-risk the results table that you get. I leave that thing unchecked all the time when I trade because I don't take earnings risk with my covered calls. Okay, another one is related earnings, and this isn't necessarily obvious, it's sort of second order, but like let's say you see really high premiums for one company like AT&T, but there's no earnings before the option expiration. Well, that's kind of odd. Well, you need to look at their competitors, and maybe Verizon has an earnings before the expiration date of that AT&T call that you're looking at, and Verizon's earnings are going to spike, AT&T one way or the other because they're closely correlated, companies. So you always want to look at a close competitor's earnings dates as well as the actual earnings dates of the thing that you're investing in. That might be an explanation why something is so juicy on the premium side. And then if you're in the biotech space or the healthcare space, you have to worry about the FDA. Those are really high volatility events for the companies that are dependent on them. There's a lot of startups who are basically working on a one-trick pony, like a cure for Alzheimer's or a cure for cancer or some partial cure. And when the FDA makes a ruling on whether those drugs can be used or not, that stock is likely going to be cut in half or double on the same day. So it's even more volatile than earnings. There's no really good way to automatically screen these because the FDA calendar is really a mess to try and pick apart algorithmically because there's a lot of noise. Some of them are really minor events, and some of them are really major events. And unless you click through and study and read the text, there's really no way to know. If you do want to trade healthcare or biotech, there's a couple of resources I've listed here where you can go look at the calendar of dates by stock symbol. So you can type in your favorite biopharmaceutical company and find all the dates that are relevant from an FDA point of view. But it takes a lot of work. I don't generally do it. I'm not a medical doctor. I don't understand that stuff. So I don't trade those kinds of stocks. So lastly, if you're like me and you just don't know, you can post a question on an investment forum and say, hey, why is this biotech so juicy on the premiums? And usually within the same day, someone's going to respond and tell you the reason. It could be something FDA, it could be a merger announcement, or who knows. The other thing is not good to trade around is rumors. These could include M&A rumors, new products, the iPhone's coming out in September, allegedly. Legal settlements that may or may not take place, and then what is your favorite billionaire doing? Those are probably bad people to try and follow because they have access to information and they're doing non-public trading all the time that you just can't really keep up with them. And if the rumored event doesn't come to pass, or one of the billionaires exits their position and then announces it after he's out, you're going to be left holding the bag. So I would always wait till the rumored event comes to pass, and then if I still like the thing at that point, maybe get in. And then margins are a really big one. On an up market, if you have a long base strategy, margin's awesome. In today's low interest world, you can borrow for almost nothing, and you pick anything that goes up, and you've amplified your gains. But if there's a black swan event, or the market tends to dribble down, and you're reluctant to sell because no one likes to sell their losers, margin can really hurt you. So especially if you're dealing with a retirement portfolio, and a lot of my customers are, I really wouldn't recommend using margin, or if you do, it's for very short periods of time and very small amounts, and you got to be online and have some experience and know what you're doing. Related to your use of margin is the use of margin by the thing that you invest in. And there are certain ETFs that are designed to be 2 times or 3 times the movement of some other benchmark ETF. So you can buy an ETF that's 2 times the S&P 500 or 3 times the S&P 500. So even though you're buying that without using margin, that thing itself is using margin. And these are generally for day traders. They're not really good for holding positions overnight the way that they do the math. So I can't recommend using leverage ETFs for covered calls. We have the ability in our screener to check a box and remove all leveraged ETFs from the results tables. If you don't check the box and any of them show up, we do put the symbol in red as a warning that this is a leveraged instrument. And if you hover over the stock symbol, it'll tell you the reason why it's in red. Lastly, it could be that there's some unknown reason why the premiums are super juicy. And if you just use a screener and eliminate earnings and then invest in the remaining non-earnings related things at the top of the list, you're going to get hurt because you really don't know why those premiums are so juicy. In this example, there's 5 things here, all of which have an annualized return over 200%. Now, 2 of them have earnings, so you can explain that away, but the other 3 do not. And I don't trade any of these symbols, so I don't know why those stocks would be offering premiums that juicy, but you want to obviously research that. Otherwise, you're just gambling blind if you don't know the reason. Like I said, if you have a candidate trade and you're not sure why the premiums are so juicy, if you just enter the symbol on Yahoo Finance, it's a really simple, fast way. The top 5 or 10 headlines for that symbol will probably give you the answer. Within seconds, you can know what volatility event is on the near-term horizon. If it's not there, and if you need to do a little bit more work, go to your favorite investment bulletin board and post a question: why are the premiums so juicy on this stock? And someone will answer right away. And lastly, if you're interested in covered calls specifically, the best group is on Yahoo Groups. It's called Just Covered Calls, and you can post any question there, and it's a well-lit, safe place. There's no dumb questions, and there's a lot of experienced traders who will tell you exactly why that call premium is so juicy there. And that's a free group as well to join. All right, now we're going to talk about how you can make more. Once you've taken out some of the risk elements, now how do you proactively make more money? So the number one is you want to apply a strategy consistently over a long period of time. If you do it like 3 to 6 months and you win 3 months and you lose 2 months and you're like, don't like it, then you really haven't given it a fair shot. If you read any of the long-term studies, it does win in the long run over many different market cycles. So that's the first strategy. We're going to have slides on each of the remaining ones here, how we can turn non-dividend paying stocks into the equivalent of dividend payers by selling calls, how to double your dividends. This is a common strategy where you try and get double the yield, whatever it pays, through call premium. Target yield is where you say, I want to earn X% per year on an annualized basis, help me get there. Dividend capture, this is one where you try to you invest in covered calls that all have an ex-dividend date prior to the option expiration date so that you get the dividend plus the option premium, and you try and do it in a way that you're selling enough premium that you're not going to get early exercised the day before the ex-dividend date. And then short-term options, there's a lot of people that just like activity, and if you're doing this in a non-taxable account, this can be okay because the record keeping is minimum. But if you're in a taxable account and you're buying a bunch of stock on Wednesday, hoping it's going to get called away on Friday, and you do it every week, then you're just going to have a boatload of transactions to reconcile when it comes time to do taxes. But that is a popular strategy with the weeklies. And then how do you minimize transaction costs? At the end, I'm going to show you some broker reviews on what covered call users typically use. So first, how much can you make with covered calls? I always tell people a reasonable goal is about 1% a month. That's 12% a year, and through some combination of call premiums and maybe dividends, you can achieve that. A lot of people doing this strategy will target something more aggressive, like 2% a month, and they realize they're not going to get there every month, but if they can do it 9 out of 12 times, maybe they can get 15% a year, even after subtracting out some of their losers. And if you look on the internet, you will find people who claim 3% a month or 5% a month using covered calls. And while they might do that for a short period of time, they're not going to do that every month in a row for 36 months. It's just impossible. And if they're really making 60% a year managing their covered call portfolio, they should go be fund managers. And lastly, if you use any margin, you can multiply these numbers up and down depending on how much margin you are using. So first, how do we turn non-payers into payers? This is a really common way because not every stock pays a dividend. So the strategy is just sell an out-of-the-money call against every stock that you own. And maybe you don't want the stock to get called away, so you're going to set the strike price 10% higher than the current price. And the number of months is maybe going to be a 2-month option. So if the stock goes up 10% in 2 months, or more than 10%, you might get called away, but hey, you've made 10% in 2 months, that's not bad. So most people are okay with that. You're not going to get a ton for these 10% out of the money options, but given that it's free money, why not? It's pretty common strategy to use. These examples, this was taken a while ago. Green Mountain Coffee doesn't even exist anymore, but at the time, the stock was trading $26, and it was possible to sell a 33 strike. So that's 7 points out of the money for 55 cents. And this was a 60-day trade. I didn't put that on the slide, but I should have. So for 60 days, you left yourself 26% upside, and you're going to generate an annual yield of 12% if you were to repeat this trade every 60 days. So you do this 6 times a year, and you get this 55 cents from this option 6 times a year, and it never gets called away. You're going to make 12% a year on a stock that doesn't pay a dividend. And then here's a couple of other examples from a while ago, but I think you understand the point that you can turn non-payers into payers that way. Another thing people like to do, just because it's systematic and it's an easy way to think about the problem, is to take any stock that pays a dividend and try and generate the same or more as the dividend by selling calls. So how do you do it is you take the annual dividend, divide it by 12. So in an example where our stock's paying $1.20 a year, divide that by 12, that's 10 cents a month. So you need to earn 10 cents a month in call premium in order to double the dividend yield. And then you would sell out of the money calls to do this. So here's an example of Kraft. It pays $1.16 a year in dividend. That's a 2.8% annual yield just on the dividend. So let's say we divide that $1.16 by 12. Let's round it up to 10 cents to cover transaction costs. If we were to sell a September 42, so this is about a point and a bit out of the money, we get 15 cents for that. And this isn't a fast-moving stock, so it's pretty modest call premiums. We could end up getting 5% yield when you add up the dividends plus the calls. So a lot of people spreadsheet this out and they have a strategy. You may have to sell calls that are, again, 2 months out to make it worthwhile after transaction costs, but that is a common strategy. I think there's even a website called that, Double Dividends. Okay, target yield is where people say, listen, I want to earn a specific amount of money per year. I have a goal. And so you say, I want 12% a year as an example. Then the challenge becomes, how do you find a deep in the money covered call that doesn't have earnings or any other high volatility events prior to your expiration date that generate at least 12% a year? I did this exercise this morning. So this is today's screen for an expiration date set till June 16th. So it's a 44-day trade. These were all taken about 2 hours ago. And you can see that the annualized return is all over 12%, which is our goal in this example. And they're sorted by downside protection. So I don't know what this stock is, EndLink, but if it dropped by 17% between now and June 16th, you'd break even. If it dropped by less than 17%, you'd make something. And if it stayed above 15, which is the in the money strike price in this example, you would make 14% annualized on a 44-day trade. So there's a long list of these. There's hundreds of them. I just scraped the top of the chart here. You'd have to obviously go research each of these and see if you were comfortable holding these for 44 days. But it's a systematic method to achieve a given annualized income goal. Okay, dividend capture is kind of fun because there's a lot of trades involved. People like this where they get the dividend plus the call premium. So the goal is to buy a stock that has an ex-dividend date before the expiration date, and you get the call plus the dividend. In this example, I've set the expiration date till May 19th, so this is going out about 14 days. And it's a list of all the dividends, ex-dividend dates prior to the expiration date, expressed as a covered call. And the returns shown here do include the dividend. So this assumes that you get the dividend and you get the call premium. So it's a quick way. We have a tool called Dividend Capture, which I'll show you, that makes this really easy to do. And the dividends have different tax consequences, so you have to be careful here. There's a thing called a qualified dividend and a non-qualified, and I think you have to own the stock for 60 days to get the qualified. So if you were buying the stock 3 days before the ex-dividend date and having an option expire a week later, you're only going to own the thing for maybe 10 days. That's going to be an unqualified dividend. So if you think you're getting the better tax treatment on that dividend, you won't. It's all going to be treated as short-term capital gains. But I'm not a tax guy, so go look that up. Okay, time premium capture. This is really common also, where people will buy stock and they will sell an in the money or a very deep in the money covered call against that stock. These people are hoping that their entire portfolio gets called away on expiration day, and then the following Monday they can buy a bunch more stock and maybe in different stocks and do the same thing. Again, this generates a lot of transactions. If you're in a taxable account, beware. In a non-taxable account, nothing to worry about there. These people are only going to make money from the time premium in the options they sell. They're not going to make anything from upside potential in the underlying stocks by definition, because they're selling in the money covered calls. And a lot of people do this with margin. If they can borrow money at 1%, they can have an annualized return of 10%. They make the difference. They make 9% on the spread, less transaction costs. So you have to be doing it probably for more than one contract at a time. And these are some examples. I set the expiration date going out till April, the April monthlies, and you can get 60% plus for a month and a half long trade on an annualized basis. And these are all in the money. The strike prices shown in this column are all less than the stock price shown over in this column. Some of them not very much. This is only 9 cents, but there's a moneyness slider in our screener up here, so you can change the minimum and maximum amount of moneyness. So if you want things that are deeper in the money, you just slide the right hand limit to be more deep in the money if you want to have a little more downside protection there. Okay, so which strike should you choose? I get this question all the time, and it is a fact that the at the money strikes always pay the most premium. The out of the money and the in the money are sort of symmetrical. If you were to go 2% out and 2% in, they probably have the same annualized return. The out of the money obviously has a little capital appreciation room. The in the money do not. So what is best? For one investor, may not be best for another, because one might just be going for maximum return and be able to tolerate a lot of risk. Another might say, I don't want the thing called away under any circumstances because of taxes. And so it really depends on your return goal, your risk tolerance, your personal opinion on where you think that stock's going to be at expiration, and your transaction cost. Do you want to do this, 4 times a month with weeklies, or do you want to do it once every 6 weeks or 8 weeks, with longer duration options? There is no best answer. This is a graph from our software to show an example of the SPY. This was taken a while ago, but there's 5 columns here for 5 different covered calls on the SPY, ranging in strike from 138 to 146. And this SPY is about 142 when this was generated. And the important point to focus in on is this bright green color. This is the amount of time premium available in the options for each given strike. So you can see the at the money, the 142 strikes has the most green. That's the most time premium. And then as you back away, the 140s is sort of similar to the 144s, and the 138s are a little similar to the 146s. They're not exactly the same because the stock wasn't exactly at 142 when this was taken. But this lets you see at a glance, the amount of time premium available in different strikes. And now the question is which expiration to use. Once you've chosen a strike price, how do you know how far out to go? Well, options decay in a non-linear fashion, and they decay faster as they get closer to expiration. So the sum of 3 one-month premiums will always be greater than 1 3-month premium, although the 3-month premium is going to have more downside protection in it. So you're going to have to decide where you want to be on this curve, but this is how it works. And this is why weeklies are popular, because they have this very fast time decay on the right side of this curve. So that's just how they work. Which is right for you really depends on your personal circumstances. Most people that I see will either trade weeklies or maybe the near month, because the monthlies have higher volume, so the spreads can be tighter. But if you're trading weeklies on things like Apple or the SPY, the volumes are so large that the spreads are tiny anyways. If you trade weeklies on a thinly traded stock, the spreads are going to be quite wide, and that could be a reason not to trade the weeklies on those less frequently traded underlyings, because rolling the position or exiting early if you have to could be expensive given the spreads. Now, which stock to pick? Again, this is more of a personal choice, but there's definitely some things not to pick, and to enable yourself to remove some risk. You don't want to generally choose high PE multiple stocks or momentum stocks or story stocks. Fitbit's a great example. When it came out, it was a hot thing, and then since then I think it's gone from 29 down to 6 or 8, although I think it just went up again recently. But 80% loss as more competitors enter the market and whatever. So that's kind of a one-trick pony story stock. The thinly traded stocks, where there's wide spreads, that can be bad on the stock side. It can also be bad on the option side. So you probably don't want to trade lesser known companies. If you stick to the S&P 500, you're probably okay. There's 500 stocks to choose from. You may even want to choose to a fewer number than that. Things that have tiny market caps, these include new issues or just stocks that have seen tough times and now they're trading down the pennies or the single digits. Those are generally not great choices. Stocks that have very low priced options, utility stocks. You're not going to make anything on slow movers, so not a great choice for covered calls. Leverage ETFs we talked about, too volatile. And then anything that has an earnings or an FDA or other high volatility event prior to your expiration date that you've chosen, you want to stay away from. So let's look at how you can use a screener to reduce a whole bunch of things down to just a few things. This example was taken a while ago at the time when there were about 230,000 covered calls if you were to look at the whole universe. And so we systematically removed risk, and we did it by first removing leverage ETFs, not appropriate. Low price stocks, so we said we only want stocks more than $5. I could argue that should even be $10. A PE ratio of less than 20 is what we wanted, so we eliminated things that have a PE ratio greater than 20. Those are the high multiples. And then we chose a specific expiration date. In this example, is February 18th. So there's 32,000 stocks that expire on, or covered calls that expire on February 18th that have a PE less than 20, a stock price more than 5, and are not a leverage ETF. From that 32,000, we eliminated earnings before February 18th. So there were 12,000 of those. Then we eliminated small market caps. We said we want $500 million or more in market cap. That took out about 4,000. We wanted the time premium in the option to be more than 20 cents. There's no point in selling an option that only has 5 or 10 cents of premium in it. Your transaction costs will eat all of that. We wanted the annualized return if flat to be greater than 12%. That's annualized, so that's to be 1% a month. And in this case, we wanted in the money option. So we don't want to take as much underlying risk. We want something that's already in the money, 5% or more, which is fairly deep in the money. And that reduced the set to 164. And then we said, we don't want to trade thinly traded options. So let's find contracts that have an open interest of 2,000 or more contracts. That reduced it to 49. And then I just eliminated healthcare because I didn't want to go look up the FDA. So that brought us down to 38. So this is a way, and these are all like sliders. You can do this in about 2 seconds by touching all the sliders on the site to reduce, 250,000 things down to 38 things. So now what do you do with the final 38? Well, this is where the homework begins, because it's possible, maybe even likely, that you're never going to have heard of some of those 38 stocks. Sometimes the publicly or the popular ones are in that list. That makes it relatively easy because you already kind of have a feeling about some of those companies. But if you don't know the company, if it's brand new, you may have uncovered a gem, or you might have just uncovered, something not worth investing in. You have to decide, and that's your personal homework. You don't want to just blindly invest in whatever the screener, leaves you with after you've eliminated some risk categories. So go look up each of those symbols on your favorite news source or bulletin board. I like to ask questions about other people. Someone always knows more than I do about any given stock. You never know what you're going to get back. So post a question about the symbol and say, what's up with this one? You can study the technicals. There's definitely a school of thought for that. And in general, the rule should be you never buy something that you're not going to want to own past its expiration date. Because even if you sell an in-the-money covered call on it, probably some of the time you're going to still end up owning that stock past the expiration date. And now what do? You've got a loser that you don't know that much about. You just sell it and walk away, or do you try to recover? So in general, don't go into it unless you're willing to own it past the expiration date. Okay, let's talk about brokers. There are 2 companies that publish an annual broker review every year, and one is Barron's. They do a good job. And the newcomer is stockbrokers.com. I like the stockbrokers.com data. It's a little more complete, in my opinion. And they take something like 13 different criteria, and they give everybody 1 to 5 stars. Then they layer on, your personal trading style, and there's different answers for different types of traders. And then they give you the answer for like 14 different categories. And I think I've chosen 8 categories here. So if you're only interested in commissions and fees, and that is the driving force, and you're choosing a broker, you should trade at Interactive Brokers. If you want tools and really easy to use tools, a great platform, in their opinion, you should be at TD Ameritrade. In general, if you are at any of the names on this page, you're probably doing just fine. They're all pretty good. If your broker is not on this page and you're trading a lot of options or covered calls, or you're an active trader, you can probably do better than where you are right now and switch to one of these. But you can go read the reviews yourself and see what they say about your broker. If you have questions on covered calls after today, there's 2 great places to go. One is the Yahoo group called Just Covered Calls. The other is my site, Born to Sell. You can shoot me an email. I don't give personalized investment advice, but I'm happy to answer questions on the strategy in general. I've written a lot about covered call issues on my blog. I might refer you to an older blog entry, but most of the data there is evergreen. And so, if you have a question about early exercise or how does this work, I can generally point you to resources in the right direction. Okay, now for a discount for all the listeners here today and the people who view it after this. If you were to go to borntosell.com/Wall Street, you will find that there is a special offer that is valid between today and the next monthly option expiration date, which is May 19th. So in the next couple of weeks, if you were to sign up for a free trial, and we have a field on the sign-up form that says, how did you hear about us? If you enter the word Wall Street, you will have 3 different promotions to choose from. Basically, you get 1, 2, or 4 extra months tacked onto your subscription, depending on the subscription length that you choose. And we do have 3 types: monthly, quarterly, or annual. And these are the prices for each of those on our site. And all subscriptions begin with a 2-week free trial, no obligation. So you can try everything we have for free. And if you cancel by day 15, there's no charge at all. And you have full access to everything we have during that time. And now I'm going to show you a demo of the covered call screener. Unless there's any burning questions, Micah, I'll just go with the demo. All right. Let's switch to this one. I want to switch to Google Chrome.
Yeah, I think we're good to go with the demo here, Mike. Thank you.
Okay, great. So I assume you can see my web browser at this point, Born to Sell's website.
Yep, I can see it there.
Okay, so this is the home page. I'm going to skip the public part of the site and just log in to show you what happens on the inside of the site. So this is the default screen homepage for members when you log in. It's one of our search methods, which this one is kind of a boil the ocean point of view. You sort of choose your expiration date, and if you move this slider around, the results below update right away. Weeklies are in red, the monthlies are in white. You can choose your moneyness, so if you want things that are only in the money, you can slide the moneyness filters over here. And now everything on this list is going to be 3% in the money or more, meaning the strike price is going to be 3% less than the stock price or more. This results table shows you one row per covered call. So we have the symbol, and if you hover over it, it tells you what the company is. If you were to click on the symbol, it will take you to a covered call chain page and show you every covered call for that symbol. It has the current stock ask. It has a strike price for a call option, and then this would be the bid for that call option at this moment. And our data is 15 minutes delayed. The market's closed right now, but when the market's open, this is 15-minute delayed data. And then it shows you the net debit, which is the stock price you paid less the call premium you received. So your out-of-pocket would be $20.94 in this example. Then there's a next earnings date column, which is in red in this case, May 10th. That's because we've chosen May 19th as our expiration date, and May 10th is before that, and May 10th after the close, the earnings are going to be released. That's why this is offering such a high premium. So if we wanted to remove all these red ones, which are really risky, we can click open on the Show Advanced Filters, and there's a checkbox here that says Earnings Before Expiration, and I'm going to uncheck that. And then I'll close up this advanced filters section. And now there are no red dates in the next earnings column. All of the earnings risks have been removed from the results. Actually, let me go back to the advanced filters. There's a couple other things in here that you can do. You can put limits on the PE multiple. You can increase the minimum market cap if you don't want the small companies. You can increase or reduce the open interest depending on how much you want to see there. And if you don't want to deal with tiny priced options, you can increase the minimum option price. And every time you touch a control, it updates the results table right away. And and there's also over here, you can eliminate whole sectors. Like if you didn't want FDA problems, you just uncheck healthcare. And now there's no FDA risk in this results set, which is kind of cool. If you only want the big companies, you can click on S&P 500 here. And now the results is limited to S&P 500 that are not healthcare. So that keeps you out of the little companies. Now, if you like ETFs, you can click on only ETFs, and now everything in the results table is an ETF. And if you want to go for the risk, you can click on leveraged, and here are some leveraged ETFs, which we're not going to play with. Okay, that's one search method. Oh, and then on the results table, I'm going to hit this restore default just to go back to the default settings. I will take off earnings because I never like to see those. You can click on any column to sort by that column. So if you want to sort by downside protection, you just click on the downside protection column. And here's a Facebook option. So 135, a 135 strike. So that's 15 points in the money. Oh, it's offering 0. We've got this set till tomorrow, May 5th. So let's set the expiration date at least out a week. All right. Well, that's still offering 0. Oh, okay, so the annualized return on some of these is really tiny, but the downside protection is really good. So you want to find one, like here's one in US Steel. You know, it has some return still in it, and yet it has 8.7% downside protection. And that's a 1-week trade. And it has a dividend coming up as well. So you get that 5 cents there. Let's go to the next search method, the max protection. This is where you choose your annualized return goal first. So you say, look, I want to make 24% a year, set this to 24. And now everything on this page pays at least 24% annualized return. And on this page only, it's hardwired to sort by downside protection. So the thinking is these are the deepest in the money covered calls that will pay at least the amount that you've selected. by the expiration date that you want. So if you want to go out further, say you want to go out till June, so these are further out. They still all pay 24% annualized, and the top ones here have 6, 7, 8% downside protection. So these sort of deep in the money, a quick way to find deep in the money covered calls. Dividend search is a way to do the dividend capture strategy. Everything on this page has an ex-dividend date prior to the expiration date. So let's set it to next Friday. So here's next Friday's expiration date. Here's a whole bunch of stocks that have a dividend between today and next Friday. Now, some of these, if they have really teeny tiny premium left in them, you might get early exercised on. That's a different topic, which I'm not going to do right now, but something to be aware of. The earnings search is for the risk loving. I only added this because some people are gamblers and they like this. So you are limited to companies that have an earnings release date prior to the expiration date that you've chosen. So this is for the gamblers in the crowd. The goal page is really unique to Born to Sell. Here's where you type in the amount of money you have. Let's say you have $50,000. And how much money do you want to make? Let's say you want to make $1,000. And we want to do it by May 19th, a couple weeks out. You tell it how many open positions you want to maintain. So let's say 5, that would be 5 things of $10,000 each. And you tell it if you're going to use margin or not. In this case, we're not. So then in yellow, it says, if you want 5 open positions and you want to make $1,000, each position is going to have to be less than $10,000, and the profit's going to have to be more than $200, so that if you get the profit on all 5, it adds up to your $1,000 goal. Everything on the list on the results table meets those requirements. So there's some new columns here. One's called capital required. You'll notice it's less than $10,000 in every case. It tells you how many shares to buy, and then it shows you what the profit, if flat. That means that the underlying stock is flat or unchanged between today and expiration. So you pick 5 from this list, and if all goes well, you're going to meet your $1,000 goal. And you can change this obviously with different numbers and open positions, and if you want to use margin or not. Okay, top 10, this is the volunteered data from our users. This is anonymously aggregated. So right now, the #1 most popular covered call is the Apple 145 that expires tomorrow. And then after tomorrow, this is real-time data. As people update their positions on our site, this data changes, although no single person can really affect the ordering because it's crowdsourced, so there's lots of people involved. But here you can see the kinds of things that people are buying. And if you're new and you stick to this list, at least you're traveling with the herd. You're not going to get too far off the reservation. Although I must say, once in a while, I'll see something on here that's really risky, like a biotech that's got an FDA announcement coming up, and the premiums are really juicy, so everybody piles in, and it shows up on this top 10 list. That's not my style, but apparently I have some people that are high risk lovers in my subscriber base. And then the watch list, we'll show you the watch list feature in a minute, but these are the top 20 symbols that people have entered into their watch list, which you can get a daily email after the close letting you know when things on your watch list exceed a certain annualized return. So you can say, hey, tell me when Apple options are offering more than 30% annualized return, and there'll be no email until the day that that condition is true, and then you'll get an email after the close saying now the conditions are right. So anyways, you can have this watch list as big as you like. These are the top 20 symbols sorted by frequency across all of our users. I'm going to show you the portfolio. So that was all the screener. The other half of what we do is help you manage a portfolio of covered calls. In this demonstration portfolio, there are 2 uncovered positions, there are 2 covered positions, and this calendar down below shows you, it's a personalized calendar, and it shows you ex-dividend dates and earnings dates for the things that you own. So Apple's got a dividend coming up next Thursday, US Steel has one coming up on Monday, and there's no earnings for the 4 companies in this demo portfolio. If you go to the positions page, this is kind of boring. This is just where you enter what you have, what stock, how many shares, what you pay. And then if you have an option written against it, what's the expiration date and strike, and how much did you get? And there's this income field, which is a rolling sum of all the call premium plus dividends that you've received for that position since you've owned it. So we sort of keep track of all the income you've generated. The dashboard is a visualization of your positions where there's 1 column per position. There's a lot of data here. You can sort it by different features, ascending or descending. You can show percentages or absolute dollars. depending on how you like to see your data. So this is a place where you can go to see, hey, if there's no light green in this position, then it's time to roll this position because there's no time premium, to receive in this position. So it's a way to manage your positions. The Cover Me tool shows you your uncovered positions and what is potentially possible over the next 3 expiration dates. Now I have weeklies turned on, so it's showing me the next 3 weeklies. There's these little orange arrows in the strike column, and you can click these things up and down, and it will change the strike to get to where you're comfortable with that stock based on either your basis or where you think it's going to be by a certain expiration date. And once you get these things set the way you like, down at the bottom, it sort of adds it all up, and it says if you were to execute those trades, here's how much income you could have, by each of these dates. The Roll Me feature, this is really unique to Born to Sell as well. This is a rolling calculator to help you modify an existing position. The first box in the upper left tells us what we currently have. We bought 100 shares of Apple at 145, and we sold a May 5th 145 strike call option, and we received $2.10 for that. The box below that tells us what would happen if we closed out both sides of that trade today. Buy back the call and sell the stock, we would come out $200 ahead. Now, if you wanted to roll this position going forward, over on the right here, the black is where we currently are. We have the May 145 strike, and this gray is where we could be. So we can pick a different number. Like if we want to go up and to the right, we would choose this one, the May 12th 146. And if we were to do that, it's linked to this table at the bottom where the first row is what we have. The second row is the option that we would roll to, sort of the target option. And the third row shows us the difference. So if we were to switch from the May 5th 145 to the May 12th 146, the difference is that we would make $68 in extra profit. Even though the annualized return goes down, that's just because the short-term one has got a crazy number in it. And you can click on any of these columns, and when you click on a column down here, it updates this matrix to show you that type of data. So right now we've got P&L total, and then this matrix becomes a P&L total sort of thing. So if you wanted to get $220, you click on that one, and it updates the middle row. It's a pretty cool tool. It takes a little while to get used to. It's way better than a spreadsheet. During market hours, it imports actual prices. It knows the difference between a bid and an ask on both the stock side and the call side. So everything that you see here can be achieved with the market order. And you can do a little better than this is showing you if you were to put a limit order at the midpoint when you actually place the order. Diversify Me is the graph I told you about during the presentation. It breaks up your positions into sectors. In this portfolio, we have too much consumer goods. We should probably sell that and go buy some services or maybe some healthcare. The history page is your historical results. You can sort this by option cycle or by calendar month, depending how you like to keep score. So that's kind of cool. The watch list is a place where you can type in your favorite 20 or 50 or 100 symbols. This is a little tiny box, but it gets as big as you need it to be. And you can paste in from another list. So if you had the IBD 100 list in a spreadsheet somewhere, you could just collect, copy those 100 symbols, come over here and paste it. And now your watch list is the IBD 100 or whatever your favorite set of symbols would be. Everything on the site is sticky. So the next time you come back, it's still there. The chain page is where you can type in a symbol and get the entire covered call chain for that symbol. And now if I type in Apple here, I just want to show you something kind of cool. If the question was, what's the highest yielding option available on Apple, you can click on this annualized return if flat column, and it sorts now by annualized return if flat. So next week's 147 strike is the highest yielding covered call available on Apple right now. If you don't, this kind of mixes up the expiration dates and strikes. And if you don't like that, you can click on the expiration column, and then it sorts by expiration date and then by strike, as you're used to seeing. And you can change how many options that you see at a time by clicking these radio buttons up at the top. You can also change the data that's displayed on any page. They all have these edit columns sort of links, and you can click on and off different columns and make the results table catered to what you care most about. And that is it for the demo. So unless there's something specific that somebody wants to see, I'm happy to take some questions. Let me see if I have any questions.
Yeah, how's it going, Mike? Really nice job today.
Thank you.
Yeah. Hey, everybody. Now's the time. If you have any questions for Mike about covered calls, this would be a great time to kind of pick his brain, ask him any questions. I'd love to see your top 10 here again, if you wouldn't mind.
Yeah, of course.
Let's check this out.
Yeah,
This is really great. You had a lot more going on in this platform than I had originally thought. You did a really good, nice job with it.
thank you. Yeah,
So this is,
basically, I was trading covered calls for many years prior to creating this software, and I was using an Excel spreadsheet, and it didn't import ex-dividend dates or earnings dates, and it were real-time quotes. I mean, it was just kind of a mess. So I essentially wrote the software that I wanted to use for my own trading, the
that's
genesis of it.
awesome. I
Yeah,
know you said you've been trading covered calls for a long time.
yeah.
Um, when we had talked earlier, I had asked to see if you had something special you could give our community, and you said you could give them a free trial plus like a discount if they wanted.
Yeah, that's right. So if you go to borntosell.com/Wall Street, you get to this page and it kind of lays out the bonus. So everybody gets 2 weeks free. Just
Okay.
sign up and you get 2 weeks for free.
So just
Then
2 weeks to try it out. They don't have to commit to anything, but they get 2 weeks.
that's correct.
Awesome.
Then on day 15, if they want to convert to a paid subscriber, if they use this code Wall Street when they sign up, we have this question on the sign up form that says, "How did you hear about us?" In that field, if you enter Wall Street, no space, then they'll be eligible for bonus months, either 1, 2, or 4, depending on if they sign up for monthly, quarterly, or annual. But they have to do that before the monthly expiration date this month, which is in 2 weeks.
Okay, great. Hey, that was really nice of you to give the extra free months for people here. That's cool.
Sure.
Definitely. Well, everybody, I definitely recommend checking this out. I mean, you get 2 weeks to check it out if you're interested in income trading, if you're interested in covered calls. He's kind of laid out the whole thing for you in a really, really nice, easy to use website here. Definitely check it out. Make sure to use the Wall Street coupon here because if you decide that this software is something that can really help you with your covered call trading, which I think it will, you'll get some free months. So definitely grab that special. And you're leaving this open for, it looks like, a couple weeks.
Yeah, till May 19th.
Okay, cool. Very cool, everybody. Let me just see if we have any questions here. So what is it like? So walk me through the sign up process. Someone's going to sign up, and what can they expect to get right afterwards?
Sure. So I'm going to log out from my signed in account. So if you go to the home page and to get started, you click on this free trial button in the upper right corner, and you're going to first ask, which kind of plan would you like to be on. They all start with a 2-week free trial, so it doesn't really
Okay.
matter. Say you choose quarterly, you enter your name and email address. You will then receive an email confirmation code, verification link to validate your email. You validate it, you come back, you choose a username and password, and then you're good to go. And at that point, you have full access to everything I just showed you. So your experience, you're going to log in here with your username and password, and you're going to see this. You're going to have the full site functionality. Now, if you decide you want to cancel, it's real simple. On the account page at the bottom here, there's a cancel subscription button, and no questions asked. It removes your liability. And if you forget to cancel and you want to, you get charged and you call me up 2 days later and say, I forgot to cancel, we'll refund that. It's not a problem. We're not here to trick anybody.
Awesome. That's really nice. So do you have like training videos or something like that for people to get
Yeah.
started?
Yeah. So down at the bottom in the footer, if you click on this YouTube icon, it will take you to Born to Sell TV in
Okay.
YouTube. And there
Awesome.
are probably a bunch of videos here with my voiceover showing the software.
Perfect. So that's easy to follow videos, so they'll learn exactly how to use all your tools.
Yep.
Awesome, man. Well, do you have that link to your the Wall Street AO page that you could put in the chat room for everybody?
Sure. Let me just copy this and then paste it here.
Perfect. So we're going to put that link right to the page here that goes over the bonuses that you're going to get from coming from this webinar. So if you're interested in checking this out, you get 2 weeks for free, and then some discounts if you decide to stay after. Click the link that we're putting up in the chat room for you now. And very cool. I think that's it for questions, Mike.
Okay, very good. Well, thanks for the opportunity and thanks for everyone attending. And if there's questions afterwards, feel free to shoot me an email. It's
Yeah, what's
Mike
the best way to contact you, actually?
Sure, it's real easy. My first name, Mike at borntosell.com.
Okay, perfect. Awesome,
And
everybody. Thanks for being
one
here. Go ahead.
I was just going to answer one question I saw pop up in the chat room. Someone asked a question about dogs of the Dow in using covered calls. And if you search on my blog, I wrote an article about this exact strategy. I'll paste the URL in the chat window here, and the guy can read that.
Oh,
But covered
perfect.
calls, yeah, it's a good strategy.
Perfect. That's actually a really good question, too. Thank you for that. It looks like you have a lot of great resources here on your blog, too, for everybody. This is just free for people to go through, right?
It is, and we also have a free company newsletter. No obligation to sign up. On the homepage, uh, near free trial, there's a button that says free newsletter. That
Mhm.
comes out about once a month, and covered call information there as well.
Cool. Awesome, Mike. Thank you so much for answering that last question. And I think we're good. All right, everybody. Thank you for joining in today. Huge thank you to Mike here from Born to Sell. Definitely take him up on his free 2 weeks and check out all the cool resources he has for making more income in your trading. We put the links in there for you, and have a great day. Thanks again.
Thank you.